In the last 100 years, one investment has crushed the other so badly it almost feels unfair. And yet somehow, the people choosing the weaker one keep ending up far richer. That shouldn't happen, but it does, every single time. And the reason has nothing to do with picking the right market, timing the cycle, or even choosing the better asset. It's something most people never notice. And once you see it, you can't unsee it. So here's the official story. Stocks are the best long-term investment. That's what every textbook says. Over time, they return around 10% per year. Adjusted for inflation, it's closer to 7%. That's strong, consistent growth. Real estate, on the other hand, barely keeps up. Home prices rise slower, sometimes just inching past inflation. If you only look at appreciation, it's not even close. Stocks win. That's the simple version. But when you look closer, that story doesn't quite fit, because homeowners on average end up with dramatically higher net worth than renters. Not slightly higher, not double, massively higher. So if stocks are better, why are the people investing in houses winning? My name is Nathan, and I spend way too much time thinking about how money actually works. Please do me a quick favor, show your support, and hit the subscribe button. If you put $100,000 into the stock market and let it grow for 30 years, historically you'd end up with well over $1 million. That's the power of compounding. Do the same thing with home price growth alone, and you're looking at a fraction of that. So logically, the conclusion feels obvious. Just buy stocks. Forget real estate. But this is where things start to break, because real estate has something stocks don't. A multiplier, and it changes everything. When we buy stocks, every dollar we invest is our own. If we put in 100,000, we control 100,000. But when we buy a house, something different happens. We put down a fraction of the price, and a bank covers the rest. Now we control an asset several times larger than our actual cash, and every bit of growth on that full asset comes back to us. This is where most people underestimate what's happening. Imagine you buy a house for $400,000 and put down $80,000. If that house grows by just 3%, that's $12,000 in value added. But you only put in $80,000. So your return isn't 3%, it's closer to 15%. And that's before anything else even enters the picture. Now add the fact that you're slowly paying down the loan. Each payment increases your ownership. So now you're not just gaining from appreciation, you're also gaining from the debt shrinking. Suddenly, a slow-moving asset starts acting like a fast one. And this is the part that makes people lean in, because now the gap starts closing. If the house grows a little faster, say 5%, your return jumps again. Now it's competing with stocks, sometimes beating them. And that's why real estate feels like a cheat code. But there's a catch. There's always a catch, because that multiplier works both ways. And this is where most people stop thinking. But we don't. We ask a simple question. What happens when things go wrong? Because markets don't only go up. And history has already shown what that looks like. During major downturns, stocks can drop hard, sometimes over 50%. That's painful, but they tend to recover over time. If you hold on, you're usually fine. Real estate looks safer on the surface. Prices fall less, at least on paper. But the recovery takes longer, much longer. And when leverage is involved, the experience changes completely. Imagine that same $400,000 house. If the value drops by 20%, the house is now worth $320,000. And guess what? You still owe around $320,000. Your equity is gone, completely wiped out. You didn't lose a portion. You lost everything you put in, and now you're stuck. You can't sell without bringing money to the table. You can't move freely. The asset you thought you owned now controls you. Stocks don't do that. If your stock portfolio drops, it hurts, but you still have options. You can sell. You can move on. You aren't trapped. So now the story gets more complicated, because real estate isn't just about returns. It's about risk tied to that multiplier. And most people only focus on one side of it. But we keep going because there's another layer most people ignore: costs. And this is where things get even stranger. When someone says their house went from 200,000 to 500,000, it sounds like they made 300,000. But that's not the full picture. Every year, there are expenses quietly eating away at that gain. Property taxes, insurance, maintenance, repairs, things that don't stop, ever, even after the mortgage is gone. You start adding them up. Each year, a percentage of the home's value disappears into these costs. And over decades, that adds up to a significant amount. Suddenly, that massive gain doesn't look as massive. It shrinks. And yet, homeowners still come out ahead. So what's actually happening? You realize something important. It isn't just about returns, it's about behavior. When people buy stocks, they treat them differently. They check prices, they react to drops, they sell, they try to time things. But when they buy a house, they hold, they stay, they keep paying, they ride out ups and downs without even thinking about it. The setup makes you stay consistent, and consistency is what builds wealth, not the asset itself. This is the part nobody talks about, because it's not exciting. It doesn't sell courses. The system around the investment matters more than the investment itself. You see it clearly now. The house didn't make people rich. The behavior did. Leverage amplified it. Time locked it in. And discipline carried it through. So now the question changes. It's no longer which asset is better. It's which system works better for you. Because both paths can lead to wealth, and both can go wrong. If you use leverage wisely, real estate can accelerate your growth. If you misuse it, it can trap you. If you stay consistent with stocks, they compound beautifully. If you panic sell, you destroy your returns. Same tools, different outcomes. And that's the part most people miss. You may have thought this was about choosing between two investments, but it was never about that. It was about understanding the hidden force behind both. So before deciding where to put your money, there's a bigger question to ask. Are you building a system that makes you win, or one that makes you react? Because that answer matters far more than whether you choose stocks or real estate. And once you see that, the entire game changes. If this video helped you, share it with a friend. Please support the channel and hit the subscribe button.